Well, good afternoon. Welcome to this webinar from our hosts, SMEsouk at RAKBank. My name's Richard Dean from Dubai 103.8 FM, and this is Understanding Corporate Tax here in the UAE. A phrase I thought I'd probably never utter, but it's a big deal. It's happening in a year, and that's why we're all here. The UAE, as we know, is going to introduce federal corporate tax for the financial years starting on or after the 1st of June 2023. So the clock is ticking. Now, the Ministry of Finance, understandably, says it's a great idea. Any Ministry of Finance would say that. They say it's going to support investment activities, free flow of capital trade, financing services, and so on. And of course, they have a valid point. But the reason we're here today is to ask what it means for you, owners of small to medium-sized enterprises here in the UAE. That's why we've teamed up with the guys at RAKBank, specifically SMEsouk, powered by RAKBank, and they phoned a friend today. So we've got a bunch of experts. We've got leaders from Deloitte and also leaders from MI Capital. They are here to help you understand corporate tax in the UAE and plan accordingly. So here's how it's going to work today. First of all, we're going to hear from the guys at Deloitte and then the guys at MI Capital, and then it's over to you for your questions, and we want them to come thick and fast. Use the chat function on Zoom. We've all done this many times before now, so we know how it works. And then a little bit later on, in about 10 or 15 minutes time, we're going to start putting the questions to our experts, but you can start sending your questions now. That's absolutely fine. So the format is 2 quick presentations, about 5 minutes each, question and answer session, and then we'll wrap up in about 45, 50 minutes time. Right then, so let's get on with our first keynote speech. Going to introduce Jan now, Jan Roderick van Abbe, partner of international tax at Deloitte. Jan, I'm going to ask you to share your screen because I know you've got a couple of slides to share with us. It's not a long-winded PowerPoint from Jan, but he does cover some really important points. And Jan is uniquely qualified to do this. He is a partner based within the international M&A tax team within Deloitte Dubai. He's got a decade and a half experience with direct international taxation. He was previously with Deloitte in Singapore. Before that, with Deloitte in Switzerland.
Between 2015 and 2021, there was increased pressure. There was a lot of noise around countries that did not have tax. And there was a new development, the so-called global minimum tax, which will impose a 15% minimum tax on profits wherever they are generated. So there was a lot of pressure. And in response to that, the UAE announced the introduction of corporate tax earlier this year. In the meantime, we've seen a public consultation document being released. There was a public consultation process going on. Interested parties have commented on what has been released as part of that document. The law is for the income tax is expected to take effect from 1st of June 2023. However, if you have a January until December financial year, your first reportable period will be 1st of Jan 2024 until December 2024. Richard has been talking about some of these objectives. What did they want to achieve? They wanted to achieve a tax system that aligns with global best practices, a tax system that is competitive, and that also comes along with minimal compliance. And we're going to look at whether some of these objectives will be achieved based on what we know as of today. So I'm going to give you a snapshot of the UAE tax system based on what we know today. So first question, who is going to be subject to tax? It's entities that are incorporated in the UAE. So whether you have an LLC in a free zone or a private joint stock company in mainland or a branch, those entities are going to be subject to tax, meaning they're taxpayers. They have to file a tax return. Also, foreign entities could be subject to tax. So if you have a business abroad, but you conduct business in the UAE, you could potentially be subject to tax because you have activities going on in the UAE. The other thing to remember is there is no taxation for individuals. However, if an individual carries out activities under a license, such an individual could be subject to corporate income tax. So that will potentially be a contentious area. Generally, only individuals that require a license will be subject to tax. But what about, for example, someone that is trading in cryptocurrencies in his personal capacity, or a person that is a board member of many boards of different entities? Would these people be subject to corporate income tax? That's an area that requires more clarification. What is subject to tax? So the tax base, the starting point for your tax computation is your net accounting profit according to your financial statements. There will be some adjustments with regards to income and expenses. Some income items will not be subject to tax, such as dividends, and some expenses may not be deductible, such as entertainment expenses where there is a specific cap. Tax losses can be carried forward and also shared between group entities. Once we've established your tax base or your taxable profit, what's the rate that is going to apply? There are two main rates. One is 0% for profits up to 375,000 dirham. And then there is 9% for profits in excess of 375,000 dirham. Plus, there's a higher rate for multinationals, so very large entities that have consolidated revenues of more than 750 million euros could be subject to a higher rate. Hopefully, that will not apply to you being a small and medium enterprise entity. What needs to be done? Taxpayers need to file a return 9 months after the end of the financial year. So if you're December 2024 financial year end, you would have to file in September 2025. No advance payments will be required. Obviously, there will be penalties for non-compliance. Transfer pricing, what we mean with that is transactions between entities within the same group. So if you're part of a group that has different entities, transactions between the entities need to be priced at arm's length, meaning they need to be in line with market pricing, and these transactions would have to be documented. Last but not least, there will be certain relief mechanisms for groups. So if you're a group, you can be part of a fiscal unity and only file one return. So some helpful tools if you are a group. Now, what does that mean for entities in the UAE? I would say broadly, the implementation of corporate income tax is comparatively less complex than VAT. You don't necessarily need to be ready on the 1st of January 2024 because you file much later, but still some preparation would be recommended. And it really depends on your business model and the complexity of the transactions you have. In print, generally, we would recommend to do a high-level impact assessment already now before the issuance of the law, but you may as well wait until the law is issued, have a look at what the impact will be, how your income streams will be taxed, whether you have expenses that are not deductible. And based on that assessment, you can do some implementation work based on the findings that may require changes to your legal structure, operating model, systems, and so on. So with that, I will conclude my presentation on corporate income tax and hand over back to Richard.
Yeah, and thanks very much indeed. Questions already coming through. Use the chat function on Zoom. We've not only got Jan, but we've got his colleague as well joining us on the Q&A session, Maria Cristina Hernandez, to answer your questions. But we move on now to our second and indeed final presentation on these issues. And it's someone else who's extremely well qualified to answer your questions. With MI Capital, where he's a partner, he is Sheetal Soni. Now, he's a CFA charter holder. He's a chartered accountant, but as well as working in professional services, he's also been on the inside of corporates as well. He's been with, for example, Abu Dhabi Ports and Kizad. He's been with Aldar Properties and Dayar Properties as well. So he's seen it from both sides, both as an advisor and consultant, but also in-house. So his experience is particularly relevant. And with that, Sheetal, I'm going to hand over to you and ask you to share your screen with us. Thanks very much indeed, Sheetal.
Thank you, Richard. Can you please confirm if you can see my screen?
I can see your screen and I can hear you loud and clear. All is well in the world.
Perfect. Thank you. So first of all, I wish to thank RAGBank, business banking team, SMEsouk, 103.FM for this opportunity to present on proposed UAE corporate tax regime. Further, thanks to Ian for covering this overview of UAE tax regime at a very extremely well. Since this event is being organized by SMEsouk, we'll try to cover some of the important topics, particularly for the SMEs and micro SMEs. Generally speaking, as Ian also covered, relative to global tax regimes across the world, UAE regimes is designed in a very simple manner, while at the same time adopting the best international tax practices. The only area where one may feel it gets little complicated, similar to the confusion one gets into while opening an entity in UAE, is understanding this in context of the web of free zones in UAE vis-a-vis the mainland. I'll try to cover following relevant topics for SMEs in particular. Special reliefs and provision for free zone entities, compliance requirements for free zone entities, set off and carry forward of losses, provisions for tax groups and transfer of losses, allowability and disallowability of certain expenses, restructuring reliefs, and withholding tax provisions. Well, to start with, free zone entities have always enjoyed special tax treatment in UAE with respect to tax and compliance, and it has been central of achieving country's aim of encouraging foreign direct investment and enhancing ease of doing business. The proposed corporate tax continues that rhythm by providing number of reliefs for free zone entities in UAE and continue to honor tax incentives currently being offered to free zone entities. As a general rule of thumb, free zone entities will require to pay 9% corporate tax from income derived from business done in mainland or with mainland entities. So free zone entities who are doing business outside UAE or within the same free zone or other free zone entities will continue to enjoy 0% corporate tax. One notable relief, particularly for free zone entities with designated free zones, their income from sale of goods to even mainland entities will be subject to 0% tax rate. Further, passive income like interest and royalties, dividends and capital gains from owning shares in mainland companies will be under 0% tax rate as well. So you can see number of reliefs being granted to free zone entities from this point. While some of the compliance requirement has been covered by Ian, but particularly for free zone entities, I would like to highlight that even if they are subject to 0% corporate tax rate, if they fall under that category, they still need to register with FTAs and they need to file the returns. It seems from the public consultation document that free zone entities also need to conduct audit from a qualified auditor within due date for claiming the benefit of 0% corporate tax regime. Again, a free zone entity which are benefiting from 0% corporate tax cannot elect to form a tax groups, which we'll cover in detail in following slides as well. Further, a free zone entity can anytime elect to be subject to regular corporate taxation if you wish to pay tax, and if you can always choose to do that. However, once this regular status is granted, it cannot be revoked. So, moving forward, let's understand the provision for carry forward of losses. Interestingly, UAE corporate tax proposes indefinite carry forward of losses subject to certain conditions. It is very helpful for startups who normally incur losses in front years and turn profitable in later years. However, such benefit of carry forward of losses can be availed post implementation of corporate tax regime, which is 1st of June 2023. Any losses prior to 1st of June 2023 is not allowed to carry forward. There are some special provisions and relief for business groups who operates with more than one entities. Operating through a group of entities can increase the overall tax burden and compliance cost, where each entity needs to report their taxable income on a standalone basis. And this can result in higher effective tax rate for the group, where some companies are making profit while others are making losses. In order to mitigate this, the UAE tax regime will allow full consolidation for tax purpose. That's called tax grouping. Hence, the group of companies can elect to form a tax group and be treated as a single taxable entity. provided parent company holds at least 95% of the share capital and voting rights of its subsidiaries. In addition, even if the group of companies do not meet 95% co-ownership requirement, or they do not form a tax group, still there is a regime still there is a provision in UAE corporate tax regime that allows transfer of losses from one entity to another wherever there is a 75% common ownership amongst themselves. Now, coming to allowability and disallowability of expenses, and this has always been a debatable point across the global tax regime. As per UAE corporate tax regime, most expenses are allowed as per IFRS or international best practice accounting principles. However, there are certain expenses which will not be allowed or capped to a certain limit, mainly interest expenses, which is allowed only up to maximum 30% of your EBITDA. Entertainment expenses is only allowed up to 50% of the expense. So your wining and dining expenses, unfortunately, are partially allowed only. In addition, any administrative penalties and donation to non-approved organization will not be allowed. There are certain special provisions, which Ian also mentioned, and reliefs for business groups who undergoes business restructuring. Groups or organizations with multiple companies undergo business restructuring and reorganization to adopt changing economic environment and business objectives. This restructuring reorganization within group could result in tax liability on realization of gain of assets or on being transferred to another entity, another group entity. A special relief has been provided under UAE corporate tax regime for groups doing restructuring or reorganizing as long as they maintain 75% of the similar ownership between these companies post restructuring. So they have been mindful of any restructuring, any undue tax being charged in such cases. Final word from my side is on the withholding tax. Withholding tax has been kept at a simple and a blanket rate of 0% for all the payments and business with foreign entities. Thank you. Thank you from my side. Thanks yet again for RACBank Business Banking, Richard 103.FM for this opportunity. My last piece of advice would be stop thinking the 9% as your money. It's not your money any further. And gone are those days when maintaining the books of accounts and records were very low on priority. This thing one cannot avoid now. Prepare yourself for the upcoming regulations, understand this impact on your business and make necessary changes for your efficient tax planning. Thanks again.
Sheetal, thanks very much indeed. Yeah, as the owner of an SME with my wife, I remember 8 years ago when we set it up, the accounts were a kind of crude spreadsheet and that was fine. Then VAT came in and changed all of that, and this is going to change it even more. So we've got a few people on the panel today. The questions are coming in. The chat function has now been turned on. You might have had a couple of problems a little bit earlier on, but I promise you it's now switched on and they are coming in. So as well as Sheetal and Jan, who are going to be answering your questions, if you've got anything related to banking, delighted to say we've got our host today, Dheeraj Kunwar, with us, Managing Director, Business Banking at RACBank. And I know for a fact that he and the team are getting questions about what might this mean for my credit score? What might this mean for my bankability? What might this mean for my access to loans and the interest rates I'm paying? So those kind of questions about banking, Dheeraj is always happy to jump in on those. But I'm going to kick off by welcoming our panelists today, Maria Cristina Hernandez, Senior Manager, International Tax at Deloitte here in Dubai, so a colleague of Jan. If I could ask you to unmute your microphone, Maria, and I'll say a very good afternoon to you. Thanks very much indeed for joining us.
Thank you, Richard.
My first question to you is some international context, because your background is very varied. You got your bachelor's degree in law at university in the Dominican Republic, your master's degree in international tax, your law in the Netherlands. You've worked in the Americas and also in the Middle East. So you've seen more mature developed markets, but also an emerging market that's relatively new to tax. In practical terms, what advice would you give to the SMEs in terms of the to-do list between now and June 2023?
I think that from a practical perspective, what SMEs should be thinking about is what is it that they needs to be done and what is the impact for their business. What you wouldn't want to happen is that comes 1st of January 2024 or whenever the corporate tax is going to be applicable to you, and you still don't know how this is going to affect you and how it's going to affect your sort of shareholder value. So my advice from a practical perspective is know how, from a quantitative perspective, know how this is going to impact your business, because otherwise what you don't want to happen is that the corporate tax is applicable and you start basically with the wrong foot.
Okay, so how do people build that capability? Option one is you get a big four firm like Deloitte. They know what they're doing. People like you and Jan know what you're doing. Sheetal know what they're doing. Great. But for an SME, particularly an S, maybe not an M, but for an S, that level of expertise is probably out of reach. There's just not enough of you apart from anything else. So what can they do to build that in-house capability and then bring in some third-party consultants as well without just throwing too much money at the problem?
I mean, we live in a world full of information, right? So the first thing is most of the tax functions, and this is across the board regardless of the size of the business, have not been historically concentrated on direct tax. So the first step is getting in the business a person that is specialized in direct tax. If that is not possible, then obviously go through certain trainings or get sort of up to date with how the corporate tax will apply. I'm guessing that there's going to be a lot of information out there on how once the law comes out and how the corporate tax is intended to be applicable. So get that knowledge inside the business so that the business has the tools to make the right decisions.
Sheetal, if I can bring you in here, and a similar question, advice to people on building that tax function, both in-house and using external advisors as well. To an extent, as I mentioned here in the UAE, we've been through that as SME owners with having to accommodate for VAT. So we needed tax advisors to come in. So there's a bit of a capability there. We're not going in completely raw, but what advice would you give?
Yeah. So first of all, the document on public consultation document, the regime will be very, very simple. And you need to understand it only at the first time. And then if your business is regular and similar structure you are following, unless there's a big change into your business structure and the way you do business, it will not be that complicated. And I've worked enough with SMEs as well, and I've seen it is very difficult for them to employ a dedicated accountant or a tax manager. Better go for outsourced services in that case, wherein somebody pays you visit on a monthly basis or on half-yearly basis, give you a proper advice. We work with RACBank also provide some complimentary services, particularly for SMEs, free consultations for some of the activities, and we'll try to extend that services as well for tax regime if possible. So for SMEs, I think it is a challenge, but at the same time, till 375,000, I mean, the authorities have gone very light as far as the taxable slabs are concerned. For SMEs, it will be very beneficial, and you cannot not have tax advisor. You better have, if you cannot afford it in-house, go for an outsourced one at least.
Okie dokie. Questions coming in thick and fast now, so I'll get through them as quickly as I can. This one from M. Fati, who says this: I'm a free zone service consultancy. I work mainly with international entities outside the UAE or for companies in other free zones in the UAE. Are we going to pay corporate tax? Jan, I don't know, do you want to have a stab at this one, or anyone else?
Absolutely. I mean, I think the business model that you just described is very similar to our business model. So we're established in the DIFC. Most of our income is coming from abroad, or let's say 50-50. We have a lot of onshore income, which we account for. So unless we change anything, the onshore income will taint all of our income. So the onshore income will be subject to 9%, which will taint all of our overseas income as well. In order to mitigate that, and that's also set out in the public consultation document, you could have an onshore branch and allocate your onshore branch, your onshore income, so your income from mainland customers to your mainland branch, in order to protect and ring fence the international income, and in order to secure the 0% on your international income. So in your case, it seems that you also have some onshore income, which would taint everything. So you want to make sure that you segregate your onshore income from your international income in order to secure the 0% on your international income.
Thanks very much indeed, Jan. Here's an interesting one from Joe, who writes in, as salary is not taxable, what stops a sole trader business from taking a high salary to give themselves a profit lower than the threshold of 375,000 K or 375,000 dirhams? And I would extend Joe's question to say that doesn't just have to apply to a sole trader. If there's an owner manager with 100 staff, that owner could pay themselves a salary of 90% of profitability rather than taking profit as dividends, which they might have done before. Is there anything to stop them doing that? I don't know, Maria Cristina, would you like to have a stab at that? But I'd also like to get the other guy's take on it.
Of course, yes. So I think this is a typical structure that where you allocate an excessive expense. Now, what we don't see yet in the public consultation document is what are the general conditions for you to be able to deduct expense. So you're assuming that the whole salary will be deductible. However, most of the countries around the world have rules around excessive deductions, or when you are not able to, or when the expense is not proportionate to the business. So observing those conditions, if those conditions are met, then you shouldn't have an issue, but definitely something that you would need to take into account at the moment you're analyzing that.
Okay, fine. So if you own a business that does 100 million dirham profit and you decide to suddenly pay yourself 99 million dirhams salary rather than take it as profit, that's not going to wash.
Sorry, go ahead.
No, I was just wanting to add that we are hoping this is a burning question, and unfortunately this has not been, as rightly mentioned, not been clarified in the current document, but we hope that this clarification should come, in the draft regulations that we may see going forward. This is a burning question out in the market.
Right, we've got one from FB here. So the 9% rate, would that apply only on income exceeding 375,000 K dirham threshold, or once you tip over 375,000, do you get taxed on all of it? So I guess, for example, if you earn 380,000 dirhams, do you pay 9% on all 380K, or just on the 5K above the threshold?
So if it's it would be on the income that is above the threshold. So what the UAE is proposing is what it's called a progressive system. So whatever you earn below 375,000 dirhams, then it would be zero. If you have 376, then you will be taxed on 1 dirham, basically.
Okay, there's quite a lot of questions coming in from, I think, people who own their businesses and looking at what can and cannot be offset against profitability in terms of remunerating themselves in different ways. For example, Menek Ali writes in, are housing, flight tickets, salaries of owners open to a limit on expense, which is kind of the same question as we addressed before. Also, can an owner loan money to the company at a high interest rate to ensure that the profit remains below the threshold?
I mean, there's a lot to unpack.
A line here, maybe.
There's a lot to unpack. So one thing that the public consultation document does says is that the payments that you're going to be able to deduct from your taxable income needs to be related to taxable income. So for example, if your house is there, that's not really related to a generation of taxable income. With respect to the loan, there's a specific limitation on interest. So you may not deduct whatever amount you want as interest expense. You would only be able to deduct 30% of your EBITDA. So there may be limitations and questions about how deductible, if those items would be deductible.
And I guess, sorry, carry on.
No, I was just trying to add that, I mean, public consultation document specifically mentioned about also entertainment expenses. So if you are flying for business purpose, maybe, but if you are doing an event, which is like taking your customers and suppliers for wining and dining, it will not be. So they specifically cap it at 50% of your total expenses. So you need to be mindful of those things as well.
And maybe just one more comment. So any transactions between a company and the shareholder, these type of transactions will be subject to very high scrutiny. Why? Because effectively you are dealing with the same person, because the shareholder is able to control the company. And that's what we refer to as related party transactions or connected party transactions. These type of transactions need to be at arm's length, meaning that they need to be in line with market pricing. So whatever you pay the shareholder as a salary would need to be in line with what you would pay an independent person that does the same job. Now that's going to be a challenge, but I'm pretty sure that over time there will be some established practices as to what will be acceptable. But these transactions also need to be disclosed in a disclosure form as part of the tax return, and potentially special documentation requirements will apply to these transactions as well. So it's not going to be as easy as just making high payments and reducing your profit. But at this point in time, we just need to wait until we have further guidance on this.
Well, Adnan writes in with a similar question, talking about a bonus to a shareholder or a partner or a director. How will that be benchmarked? I don't know, if you're working in the shipbuilding industry or a services company, whatever it may be. What maybe actually, if I can bring you in, Maria Cristina, because you've worked in different jurisdictions, and I know Jan, you have as well. How does this typically play out? What have you learned from those experiences?
So that's a very good question. And the benchmark usually, this goes back to what Jan was referring to. So these types of transaction may be subject to transfer pricing rules. And basically you would benchmark against market practice. Now, the challenges with this type of roles is that it's difficult to benchmark, especially, for example, in startups where the founder is sort of the brain of the company, and it's hard to benchmark, but definitely it will bring its own challenges. But you basically benchmark against market practice or market prices.
Joe's written. Sorry, carry on.
I think it's not a transaction that is that is for which there are a lot of benchmarkings, because there's I can't remember which countries only have corporate income tax but not individual tax. So it's not something that is an issue in many other countries. What you see though, for example, in Switzerland, where dividends are subject to a very low rate if you have a qualifying shareholding, and salaries are subject to a much higher rate. It's sort of the exact opposite, right? So you have an incentive to distribute dividends instead of paying salaries, which would be subject to social security and individual income tax. There is some case law which we can refer to. But in the end of the day, it's a benchmarking. So you would access databases that have, this type of data, and you would look at, what does a manager having, authorities X, Y, Z normally earn. Obviously, that's not going to be one number. That's going to be a range. And as long as you are within those ranges, it should be acceptable.
Joe has written in, this is interesting, saying, I'm an accountant. I have a small accountancy business. Would my clients need to be audited for me to submit their tax returns? And this is interesting. Myself as an SME owner, we produce fairly detailed accounts with 30 people. So it's a small business. We have an in-house accountant, but we're not actually audited as such. What light can you shed on that?
So, sorry, go ahead.
Yeah, please, Maria, go. Yeah.
So the public consultation document states that the requirement to have your financials audited will depend on the company law you're subject to. So if you are in a free zone, the company law of that free zone, or if you're in mainland, then the company law of a mainland entity. Now, the question is, that is the requirement, but the question is whether you really want to not have them audited. And the reason for that is that there is going to be a lot of scrutiny on the financials, because the tax system and the taxable base will rely a lot on the accounting and financial basis. So you really want to make sure that your financials are 100% in order and in accordance with IFRS or another generally accepted principle, because that's gonna be your starting point for your taxable base.
I would like to add one point here, that the public consultation document talks specifically about auditing if you want to claim 0% tax benefit. However, it only talks about maintaining adequate records when you are subject to regular tax regime. So if any entity, if you want to claim 0% tax benefit, trade benefit, particularly related to free zone, I think audit has been made compulsorily, even, apart from, commercial companies law that requires anyway, which was not effectively enforced earlier in UAE. I think the corporate tax regime would require you to be audited as well.
Right. I think I'll like to make a few general observations, borrowing our experience from different countries where tax has been there for time immemorial. And over a period of time, there's no denying that there'll be some pain, as we go towards the compliance. But in long term, the cost of non-compliance will be far bigger than the cost of compliance. The second point is bookkeeping, book record, and profitability check is not the government prerogative. It is first prerogative of the business owner. It is incidental because that government has to see the records and the basis of taxation. But it is always in the interest of the business owner to see whether the business is profitable. And during our conversation with a lot of good, likable small businesses, at many points they struggle to even know their own business whether it is profitable or not. Third point, it brings disclosure, it brings sustainability to the company and to the country as such. And the SME, by design, by putting book records audited and compliance, they become far more bankable. So a lot of the credit issues that they go through also gets better and gets solved as they become more bankable, and there is more credit offtake towards them in a tax regime because of the heightened disclosure.
Diraj, thanks very much indeed. So many questions coming in. I think, Diraj, to quote Chief Brody in Jaws, we're going to need a bigger boat. I think we're going to have to do another tax event in the not too distant future, but I'll get through as many as I can. How are we for time? We've got about 10, 12 minutes left. So many questions coming in from owners of businesses about how they can bump up salaries to reduce profitability. This one's come in from Chandran, who says, is the salary not only paid to the owner, but what about their spouse or their children who are employed by the company? To what extent can that be offset? I guess it depends, back to Jan's point about benchmarking their salaries. But if you suddenly, if you appoint your husband as, I don't know, chief marketing officer on 100,000 dirhams a month, even though he spent his life as an engineer, who's going to stop you, Jan?
Look, as a general rule, there's the famous benefits test. So whatever expense you have, what you need to demonstrate in the end of the day is that you received value, that there was a benefit that the entity received for which it made the payment. Now, normally in a third-party context, so if you're dealing with Carrefour or Spinneys, that may be subject to less scrutiny. At the same time, if the Spinneys expenses are quite high, they may ask whether what the company is doing and is paying for dinners and lunches for its employees. But if the payment is to a related party, and a related party is basically anyone, there's quite a wide definition of what the related party is anyone that is connected to the entity. That can be, and the connection can be through shareholding or kinship or a similar relation. So a spouse of a shareholder of a company would be a connected party. So payments to that person would have to be disclosed. And you have to be able to demonstrate that the person is actually working for the company, potentially with regard by way of records and so on. So it's not going to be that simple.
Jackson Chen has written in with a really good question, saying, I'm a non-resident seller. I'm located in China, but I do sell products in the UAE. I haven't got a company in the UAE. Do I need to register for corporate tax?
So if I may take this, yeah. So if any foreign entity selling goods to UAE or UAE entity, they are not required to. It's an export of goods from the home country, and they'll be subject to their home country regulation unless they operate through a branch in UAE, and that branch does business in UAE. In that case, the branch needs to be registered with FTA, and you will be subject to corporate tax. Now, coming to the withholding tax part of it, with most of the regimes globally apply for if you derive profits or income from UAE, there is a provision for withholding tax in many countries, which fortunately for the time being, it looks like UAE have decided to go at a simple 0% withholding tax. So anybody who is buying from you, the obligation for him to keep any withholding tax has been kept away and kept it very light at 0% from the UAE. Hope that answers.
Thank you very much indeed. We're running a bit short of time. We've got a few questions. They're more points of clarification. Can we do these rapid fire? I don't know, Jan, maybe you can do this. They're almost yes or no answers. Is this a profit tax or a personal salary income tax?
Profit tax.
Profit tax. Okay, fine. Is the 370,000 dirham threshold on gross turnover or profitability?
Profit, so net income, not gross turnover.
Okay. Anjum has maybe a slightly more nuanced question. Anjum writes in, will depreciations be deductible?
Yes, they will.
Yes.
Okay, fine. And there's a standard accounting practice and that will be followed. What about marketing expenses related to either product launches or to do with advertising campaigns?
In principle, any expenses that are incurred in connection with the business or in the production of income will be deductible. So the answer is yes, as long as they're incurred in connection with producing the income.
Fine, so long as the product launch doesn't involve massive food and beverage expenses and isn't in the Maldives, to Sheetal's point earlier on. I guess that there are limits to that. What else have we got? There's so many coming in now. What else can I get to you? Javed has written in. Lots of questions coming in, and Javed actually summarizes this quite well. The branch of a foreign company, profit which is taxed in the jurisdiction of its head office company. And we've had, this speaks to Jackson Chen's question. He's based in China selling into the UAE. Someone else wrote in saying we're an SAP licensed service provider. We're based in Germany, but we sell into the UAE. We're taxed in Germany on this. What about double taxation? Any thoughts on that?
So what would happen is, first of all, if the company is outside and you have a branch in the UAE, it would be up to the other country to relieve double taxation, not really the UAE. If it's the opposite, so you have a UAE entity with a branch outside, the public consultation document provides two mechanisms to relieve double taxation, either a credit or an irrevocable election for an exemption.
Okay, thanks very much indeed. A question on the process of actually preparing your accounts to make sure they're adequate records, I think was one phrase that was used earlier. And Fadi writes in on this, will we need to have specific ERP systems, or is there no need for a specific ERP system if we provide the corporate tax income in any form that will be requested by the government? I guess in some ways it's a software question. Are there certain softwares that are okay and on the approved list, or is anything, if it's reasonably good, does anything go?
I think it does not, the consultation document does not proposes any specific software or any specific, it only talks about maintaining adequate books of accounts and records. However, However, I can assume the life will get little complicated whenever there is, a part of income is subject to tax, part of income is subject to 0% tax, which you want to claim benefit for. And, revenues can easily be segregated in most of the ERP softwares. Segregation of P&Ls gets little complicated, when it comes to, allocation of a lot of common expenses also into it. So you need to be prepared with the right set of ERP, which can, help you prove what you want to prove.
And just to add to that, I think that one thing that you need to take into account is that the ERP, the necessity of the ERP is really how to sort of reflect on how much automated you want the process to be. So the ERP helps your process to be automated. That means that less sort of mistakes or risk for mistakes in your tax return. But if you take it sort of blatantly, what is in the public consultation document is an exercise that you could do manually as well. Your ERP comes into play when you want the process to be a little bit automated or more automated, depending on your ERP and the extent and the capabilities of the ERP in general.
Okay.
And just to add from my side, I mean, I think it really depends on what ERP systems you have. But another point we didn't really touch on, but it's really around profit margins. Yeah, because what will happen is that your suppliers, they will increase their prices, which will have an impact on your profitability. So you may want to revise your pricing as well. Can you do that? If you have contracts, long-term contracts, do you have tax stability clauses in your contract? We don't know where this is going. It's a 9%, it's a 0% withholding tax. That could all change. So you want to be, you want to make sure that if you're about to enter into a contract, that you have some protection there.
Okay, cool. We're out of time. Diresh, can we just go on for a few more minutes? Because there's still quite a lot of questions coming in. I know people are busy and they've got to go. Are we okay for just a few more minutes, Diresh?
Sure.
Yeah, excellent. With the caveat, like I said earlier, I think we're going to have to come back again and do one of these in a few weeks or months' time. So here's a quick one. And it's similar to Jackson Chen's question about a company based in China selling into the region. Ahmed writes in, I have a question with regard to a foreign entity who is not resident in the UAE, just selling into Noon and Amazon specifically. He mentions other e-commerce platforms are available. Is this company or individual seller subject to corporate tax here in the UAE?
I can take it. So basically, it would depend on what is happening in the UAE, because what the public consultation document says, a non-resident may be subject to tax in the UAE if it carries out business through a permanent establishment. So you would need to understand whether that non-resident entity would trigger a permanent establishment. Now, there are different ways on where you can trigger a permanent establishment. One of them is having an individual here that is a dependent agent of that sort of non-resident entity, and that may trigger a permanent establishment. Now, different from being a resident in the UAE, you would only be taxed on the income that is attributable to that permanent establishment. That means the income that is generated from the UAE activities of that dependent agent. But if you have an independent agent, let's say that you work, so let's say that you are a reseller of goods and you work with several non-resident sort of suppliers, then it's less likely that you will trigger a permanent establishment for those entities, because you would be not dependent, you will be independent.
Okay, couple of final questions and then we will wrap up. Someone writes in, I'm an offshore company in a free zone. The income we get is from residential units that we rent out. So it's rental income that the company gets. My question is whether this income is taxable under corporation tax. I guess it's a landlord question, isn't it? Essentially, maybe actually, Sheetal, do you want to take this one? Because you've worked in real estate before, haven't you? I think looking at your CV, you've had experience with Algar and also Dayar here. So
the public consultation document talks about passive income, including rental income, to be out of the scope or, in an exempt category. However, if it is a business income, if the real estate, owning the real estate and renting the real estate is the business, then it will be part of or subject to taxation in UAE. That's in my view. Other panelists can share their views on this as well.
Yeah, I would agree. I mean, if it's especially if the real estate is in mainland, I don't see this being I don't think it's listed as passive income. I know that the income that has been listed as passive income is non-exclusive, but I would tend to say that this would be income subject to corporate income tax.
Final question from Sajid. It's about which sectors are any sectors exempt potentially from this. He says, we are a medical clinic. It's a services business. Can you tell me, services business like ours in the healthcare industry, will they pay corporate taxation or not?
Almost all businesses are covered. I mean, there are certain exceptions that are mainly to do with either government entities, certain pension funds, and that's engaged in some insurance business or mining business. But unfortunately, almost all other business, even if it is, I would say they are like socio-economic beneficial business like healthcare, education, they're also part of under the corporate tax regime.
I would
special
argue
exemption.
Radio stations are a vital public service and therefore should be exempt, but I suspect I will not get my wish. We're going to wrap it up there. So many questions. Thanks very much indeed. We've got nearly 1,000 people on the call today. Really appreciate your questions. I'm going to wrap up by handing over to our host today, the guy who put this together. It's been one of the best, Diraj Kunwar from RAKBank. Thanks for putting it together. What are your final thoughts?
Thank you, Richard. I think it has always been a pleasure to get experts' view on the matters pertaining to SMEs. And it has always been our intent to go beyond banking and offer advice, offer platform, offer networking opportunities to our fellow customers. This was one of the most important topic, and we couldn't help but to address this. And I think the tax, this particular webinar was dealing less with the tax planning, but more with preparation for taxes. So we are preparing for tax in the absence of a draft law. We're just estimating what would be the compliance. But in any taxed economy, the spirit is more important than the regulation itself. And the spirit is very clear. If you make money out of UAE law of land, you have to give 9% tax. Now, whichever way it is, whether it is, unless it's a completely exempted category like free zones. So what it means to our customer is start planning for it, start keeping your records, start looking for your partners who can advise you during the process. Our job as a prime SME bank is to offer you a qualified advice. As a bank, we are not equipped or competent to consult on the matters like tax. You will have expert available in the market. You can reach out to them. We will keep curating content for you as part of our SMEsouk initiative. And we'll keep bringing expert like the way we did today. And my sincere gratitude and acknowledgement from our colleagues from Deloitte and MI Capital. We have a long-standing relationship with both of them. And it was indeed our pleasure to see your attendance in overwhelming numbers. I haven't seen many webinars where there had been this level of participation. And we almost clocked the 4-digit magical number, which is unheard in a webinar, which is generally a high and dry monologue. So thanks, Richard. Thanks, Richard, for keeping it engaged and keeping it interesting, despite tax being the topic that it is. Thank you so much. Thank you so much.
I'm going to say a big thank you again. I'll just echo that to our panelists, to Sheetal Soni, partner at MI Capital. Thanks very much indeed. To Jan Roderick van Arbe, also of Deloitte, partner at International Tax at Deloitte, and his colleague, Maria Cristina Hernandez at Deloitte. Appreciate your time today. My thoughts to you are, I hope you've got a nice summer holiday booked this year, because you ain't getting away next summer. Any of you three guys, you're going to be foot to the floor, pedal to the metal. Busy time for you. Thanks for giving up your time. Thanks for everyone who joined the panel. Quick question from me. I don't know, maybe my colleague Natasha, who's on the call, or maybe Diraj can answer this one. A number of people have asked, will this recording be available anywhere to watch in case they missed any bits and pieces? I should know the answer to that question, but I'm afraid I don't.
We can host on the SME tube of RACBank as well as Dubai Eye repository. We can host that. Yes.
Yes, we can. With that, I'll say thanks very much indeed. Enjoy the rest of your day, and we look forward to the next webinar by SMEsouk by RACBank. Thank you.